So for the purpose of financial reporting to the shareholders, this is the format used by the companies as per Schedule 3 of the Companies Act to present the P&L. For explaining this to all of you, I am dividing this format of profit and loss statement into two parts, and this is the first part. So this is the first part. Uh, Typically, whenever a company will make a profit and loss statement, it is always for a year or for a period. So it will always say income statement for the year ended on 31st March, or profit and loss statement for the period of 6 months ended on 30th September, and things like that. So profit and loss statement or income statement, these terms are used interchangeably, and they are used interchangeably, but they mean the same thing. What we only need to remember and understand, that the P&L is always for a period. That period can be 1 month, 3 months, 6 months, 9 months, 12 months, uh, or it can be any odd figure also actually, because a company can prepare profit and loss statement every month. Now, under the profit and loss statement, the first thing that you see is income. Under the income, you will find two items, and that is revenue from operations and other income. Now, let us understand what is the meaning of revenue from operations. So, what Maruti does? Maruti is in the business of making cars. So, what is the main activity of Maruti? Is to make cars and sell them, and sell them, and from the sale of those cars, Maruti generates revenue. So not only Maruti generates revenue from the sale of the car, but Maruti also generates revenue from the sale of the spare parts. So whatever income is earned by Maruti from the sale of the cars and from the spares, it is the income. It is recorded under the line item revenue from operations. Then you will see there is something else also, that is other income. Now, what is other income? Other income is Maruti is not only in the business of making car, but Maruti is also a cash rich company. So, as a cash rich company, Maruti at any given point in time will have some surplus cash available with them. As a strategy, what Maruti will do, Maruti will not keep that cash idle with them. Maruti would invest that free cash in some securities or debentures or shares of some companies, with an objective to get good return on that investment. So therefore, Maruti will earn revenue not only from the sale of the cars and the spare parts, but Maruti will also earn income from the investment, that is by way of dividend, by way of interest, and also by way of capital appreciation. That means buying the share and then selling them. So the difference is the capital gain or gain for the company, for Maruti. So all that is recorded as part of the other income. So both these components put together, that is revenue from operations and other income, is known as total revenue of the company. Total revenue of the company. Now, after the revenue, the next thing that you have in the P&L statement are your expenses. The expenses as per Schedule 3 of the Companies Act. Now, for the information of all of you, please remember, in India, we have the Companies Act 2013, which is currently in force, and there is a Schedule 3 under this Companies Act. Now, this Schedule 3 has got three division: Division 1, Division 2, Division 3. Now, Division 1 is applicable to the companies to which IND-AS, Indian Accounting Standards, are not applicable. Division 2 is Division 2 specifies the formats which are applicable to the companies to which Indian accounting standards are applicable, which means all the companies which are listed on the stock market or which are in the process of getting listed on the stock market, And remember, not only stock markets in India, but it can be also stock markets outside India. Then in all to end, any company whose net worth is more than 250 crore, to all such companies, Ind AS is applicable. That is, Indian accounting standards are applicable, and therefore these companies will need to prepare their accounts as per the Indian accounting standards. So the division 1 of schedule 3 is applicable to the companies other than those companies to which Indian accounting standards are applicable. So that means division 1 companies are the ones to which Indian GAAP is applicable, not Indian accounting standards. Indian GAAP is applicable. And then you have a division 3 in schedule 3, and division 3 relates to those companies which are in the banking, insurance sector, and for them the format that they need to follow are different. Okay, so and generally there are some differences between these formats, but we do not have to worry about those differences at this point in time, because our objective is to have basic understanding as far as these financial statements are concerned. And so under the expenses, the first item that you have is cost of material consumed. So which means if you are a manufacturing company, you will purchase material and you will consume part of that material for the purpose of producing your finished product, and that is the cost which is known as cost of material consumed. Then you have purchase of stock in trade. So it is possible that a manufacturing company will not only be doing the manufacturing, but it also be purchasing components from outside and then selling them to their customer. So it means the components that the company is purchasing from outside and selling it to their customer is not a manufacturing activity, it is a trading activity. And therefore, whatever goods the company must have purchased for the purpose of direct sale to the customer, that cost will be recorded or is recorded in the income statement as purchase of stock in trade. After that, there is a third item, and this third item is changes in inventories of finished goods, work in progress, and stock in trade. Now, what does it mean? It means, remember, you have taken the cost of material consumed, you have taken cost of the stock in trade. Now it is possible that some of the material that you have accounted for as the material cost, it is lying in your factory in the form of work in progress or in the form of finished goods. So whatever, if there is an increase in the work in progress, or if there is an increase in the finished goods, or if there is an increase in stock in trade, remember that is not your expense, that is your income. In a way, that is your income, and therefore whenever there is an increase, you will see that this figure is represented as a negative item. It simply means that 7,962, which is the change in the inventory of finished goods and work in progress, this cost has already been accounted for as part of the material cost, right? And since it is already available with the company, therefore by this amount the material cost needs to be reduced effectively, and that is the purpose of this third component, that is changes in inventories of finished goods, work in progress, and stock in trade. The next item in the expenses is manufacturing expenses, and I'm sure you all can understand it very well. So manufacturing expenses are those expenses which are incurred by a business in converting the raw material into finished product, and that is your manufacturing cost. So that means every expense that a company would incur in converting the raw material into the finished product, that is your manufacturing cost. Incidentally, manufacturing cost is also known as conversion cost. And why it is known as conversion cost? No rocket science. It is manufacturing cost is also known as conversion cost for the simple reason that this is the cost which is incurred by a company or a business in converting the raw material into the finished product, and that is why it is known as conversion cost also. Thereafter, you have employee benefit expenses. So it simply means all the expenses that a company will incur on its employees are part of the employee benefit expenses. Employee benefit expenses. So the salaries, wages, allowances, staff welfare, all these expenses, the graduation, provident fund, leave encashment, gratuity, all the expenses which the company would incur for the benefit of its employees are accounted for as employees benefit expenses. And then you have other administrative expenses. Now this other administrative expenses will include all the administrative expenses, all the selling expenses, and all the general expenses. So whatever the cost that company would incur in the administration of the company, in the sales of the company, in the warehousing of the company, and the distribution of its goods, all these expenses are recorded as other administrative expenses. Then we have the cost of depreciation and amortization. I am sure as the valuation professional for land and building, as valuation professional for plant and machinery, we are quite familiar as far as the depreciation is concerned. Let me give you some idea about what is the amortization. So remember friends, in our business, we use two kinds of assets. We use asset number one, which is tangible, asset number two, which is intangible. So how do you differentiate the tangible and the intangible assets? It's very simple. Then tangible assets are the ones that we can see, we can feel, and we can touch. So those are our tangible assets. So land, building, property, plant and equipment, computer, furniture, office equipment, aircraft, yacht, train, helicopter. So these all are examples of tangible assets. And opposite to this, we have intangible assets. And what are the intangible assets? Intangible assets are those assets that we cannot touch, we cannot feel, and we cannot see. So the examples will be the trademark, logo, brand name, copyright, technical know-how, patent, design, goodwill. Now these all are examples of intangible assets. So therefore friends, please remember, it doesn't really matter whether an asset is tangible or intangible. Since it is being used in the business, its value is diminishing year after year. And therefore, reduction in the value of a tangible asset is known as depreciation, and reduction in the value of an intangible asset is known as amortization. So this is the difference between the depreciation and amortization. So in case you would like to make a note, you can remember it this way. What depreciation is for tangible assets, amortization is for intangible assets. After that, you have the finance cost, which is also known as interest cost. It is also known as borrowing cost. So remember, every business all over the globe will need to borrow for their operations and also for their expansion. So whenever a company will borrow for expansion or for the working capital, it will need to pay interest on these borrowings. So that that interest which the company will pay on these borrowings will come in the P&L statement as finance cost or the interest cost. It is also known as borrowing cost. So it doesn't really matter. They all mean the same thing. So this becomes your total of all expenses. So now what we have? We have a total of all revenue, all income, and from the total of all revenue, we will deduct the total of all the expenses. And just for the benefit of every one of you, I'm just repeating what the expenses are. The expenses are: number one, cost of material consumed. Number two, purchase of stock in trade. Number three, changes in inventories of finished goods, work in progress, and stock in trade. Number four, manufacturing expenses. Number five, employee benefit expenses. Number six, other administrative expenses. Number seven, depreciation and amortization. And number eight, finance and the interest cost. Finance or the interest cost. So when you deduct all these expenses from the total revenue, what you get in your hand is known as profit before extraordinary items and tax. This is known as profit before extraordinary items and tax. So you can call it profit before extraordinary items, or you can also call it as earning before extraordinary items and tax. Both mean the same thing. So now let us come to the second part of the P&L statement. Now this is the second part of the P&L statement. So we start from the same point, and that is by deducting the total expenses from the total revenue, we have got the figure of profit before extraordinary items and tax. Now, from this figure of profit before extraordinary items and tax, we will need to make adjustment for the extraordinary items. Extraordinary items, which in other words can also be understood as non-operating income or non-operating expenses. Now, let me give you an example. So, company was having a piece of land, and company realized that this piece of land is not going to be used by the company in foreseeable future, and therefore company decided to sell it. And company sold it, and on the sale of this land, company earned a profit of 1 crore of rupees. Now tell me friends, is this profit of 1 crore which the company has earned from the sale of the land, is it the operating income of the company? Answer is no. Why the answer is no? Because company's business, and let's say we are extending the example of Maruti, the company, the Maruti is in the business of making cars and selling cars. Maruti is not in the business of buying land and selling land. So therefore, it is not an operating activities for Maruti, and that is the profit from the sale of the land will fall into the category of extraordinary items. And let me also tell you friends, what is the meaning of extraordinary items? The meaning of extraordinary items is very simple. Items which are not ordinary items are extraordinary items. That means these are the items which do not happen in the regular course of the business of the company. They happen once in a while. So in case if the company has earned a profit of 1 crore from the sale of the land, what will be done for the purpose of financial reporting? To this figure of profit before extraordinary items and tax, the profit of 1 crore that the company has earned from the sale of land will be added to this figure as part of extraordinary items. So remember, it is not necessary that the extraordinary items will always be positive or they will always be income. Many times they can also be expense. Let's say for example, there is a fire in the warehouse of the company. As a result of the fire in the warehouse of the company, company incurred a loss of 5 crore of rupees. Insurance company reimbursed 3.5 crore to the company. And that means what? That means company still incurred a loss of 1.5 crore. Now this loss of 1.5 crore, is it the operating loss of the company? Answer is no. Why it is not the operating loss of the company? Because this is something that does not happen in the ordinary course of business. This is something which happens once in a while. It is a non-recurring item. And therefore, for the purpose of financial reporting, from the figure of profit before extraordinary ordinary items and the taxes, in addition to adding the gain from sale of the land of rupees 1 crore, there will be a deduction from this figure, that is loss on account of fire in the warehouse of the company, and that is 1.5 crore. So after making these two adjustments, the figure that you get in your hand is known as profit before tax, PBT. It is also known as EBT, earning before tax. Now let me tell you friends, at this point in time, PBIT or PBITDA or PBT or PAT. Now these terms are same as EBIT, EBT EAT, and EBITDA. So when you say profit before tax or when you say earning before tax, both mean the same thing. When you say earning after tax or when you say profit after tax, both mean the same thing. So after adjusting all these items, then what you get a figure which is known as profit before tax. Now since it is profit before tax, you need to deduct the tax from this PBT. And here friends, let me tell you, a company does not pay tax on the figure of PBT. For the purpose of determining the tax expense of a company needs to prepare taxable profit, which is different from the profit before tax. Profit before tax is also known as book profit. And this book profit or profit before tax is adjusted based on the provisions of Income Tax Act 1961. So there are different provisions, there are different exemptions are available, there are different benefits are available, plus there are differences between how the depreciation is computed as per the Companies Act and as per the Income Tax Act. So when a company is computing its tax expense, what this company will need to do, this company will start with the figure of the book profit and will keep on making adjustment in this profit, this figure of book profit will keep on making adjustments as per the Income Tax Act, and the net amount which remains in the bottom is known as taxable profit, and it is on that taxable profit a company pays tax. Now a company can pay tax in two ways. The tax expense the nature of tax expense for a company can be the current tax or the deferred tax. Now let me also tell you the difference between the current tax and the deferred tax. So current tax is the amount of tax that the company has to pay in the current year in any case. Deferred tax is the amount of tax which is also the liability of the company as far as the tax is concerned based on the profit of the current year, but because of certain tax benefits or carried forward of the losses or carried forward unabsorbed depreciation, or because of the losses of a merged entity with the company, it is possible that because of these tax shelters or tax shields, it is possible that the liability of the company reduces. So in this case, let's say 6,915 is the deferred tax. That means the total liability for the company for the current year was 7,702, out of which 787 has to be paid in the current year, and the 6,915, even though it is the tax liability of the company for the current year, but because of the tax shields, this amount is going to be paid in future, and that is why it is known as deferred tax. That means tax which is deferred for the future. Now when you deduct you deduct the amount of tax from the profit before tax, then you have to make further adjustment for something which is known as profit or loss for the period from continuing operations is what you get. So आपने क्या किया, आपने PBT में से आपने टैक्स को माइनस कर दिया, और टैक्स को माइनस करने के बाद में जो प्रॉफिट आपके हाथ में बचा, इट इज़ नॉन एज प्रॉफिट फॉर द पीरियड फ्रॉम द कंटिन्यूइंग ऑपरेशंस. Now why continuing operations? Please understand that is because in today's world, as all of us keep on listening and hearing and reading in the newspapers, that many companies, what they do, they sell off their business. So the moment a company decide to sell off their business, which means they decide to sell one undertaking or one plant or one product or one brand, so whatever a company has decided to dispose it of in the times to come or in the foreseeable future, now that is no longer a continuing business of the company. Rather, it is discontinuing business of the company, because this is the business that the company intends to close going forward. And therefore, so you need to present for the purpose of financial reporting, for giving the shareholders a good information, you need to divide your information between the profit from the continuing operations and the profit or loss from the discontinuing operations. And I'm sure you can very easily understand why this segregation between the profit from the continuing operations and the profit or loss from the discontinuing operations, so that the reader of the profit and loss statement can understand that what the company is likely to earn in future is only this amount. The profit that the company may have earned from the discontinuing operations, which may have come in the P&L of the company of the current year, remember that profit is not going to happen in future. So that means anyone who is taking a decision about this company, he has to keep in mind that the profit in future is going to be the amount of the profit which is coming from the continuing operations, and the profit or loss from the discontinuing operations has to be ignored. I'm sure you all must have become very clear about it. And then you have other comprehensive income. And what is the other comprehensive income? Friends, other comprehensive income are nothing but unrealized gains or losses earned or suffered by the company in the financial year, right? So say for example, a company has got certain derivative products. On those derivative products, by the close of the financial year, company has either incurred a loss or has gained a profit. But remember, this is not something what the company has realized. It has only accrued but not realized actually. Not realized. So therefore, as a good practice, it is necessary that unrealized profits or losses or gains also need to be separately disclosed in the income statement. Also then they may not have been realized, but that liability a company has already suffered as of the end of the financial year, or that the gain has accrued to the company as of the end of the financial year. And therefore the other comprehensive income are also shown separately, and when you add them all together, you get the figure which is known as profit after tax, or loss for the year. Just give me a second please. Hello. Right. So this is how the profit and loss is prepared by the companies for the purpose of financial reporting. So in case if there are any question on this, I think I can leave it open to every one of you. Please ask me your question. I will take your questions before we move forward to understanding decoding profitability statement for the purpose of value creation, performance evaluation, risk management, decision making, and strategy formulations.